You know, we hear one side talking about how inflationary Build Back Better would be. The other side says it would be not inflationary. But we're still just in the planning stages. We're still talking about it. We've got 9.8% PPI. That had nothing to do with the current social spending bill because it's already happened. So where was that from? Where do we get 9.8% and what moved the needle to that extent, which was higher than we've seen in decades?
Yeah, I think there's been very clearly a big change in inflation here at the beginning of this cycle compared to all of the disinflation we talked about last cycle. There are certain cyclical elements related to the pandemic, things like supply chain issues putting a lot of pressure on goods prices. We see that everywhere, no matter what we try to buy these days. You also see this reflected in higher commodity prices, especially energy and food. That's what Chair Powell would refer to as much more transitory. I think what's also become clear is that there are also more sticky elements pushing up inflation, things like rent prices, things like wages, and things like higher inflation expectations. And that's why about a month ago, Fed members, including Chair Powell, suggested the Fed is clearly pivoting towards the inflation side of the mandate away from the employment side of the mandate. And that's why we need to get a faster pace of normalization, which we agree with Anthony should be announced later this afternoon.
Anthony, for someone that in your line of work, I mean, inflation is the one thing that you would really need to I think about to help your clients plan what to do with fixed income. It's almost like kryptonite. Is that all you think about? And what do you think is causing it, and whether it's going to be a real secular change between disinflation back to maybe even a wage price spiral? Is that possible?
Yeah, so we would argue that there are some aspects of the inflation that have been transitory, and those have already been alluded to. So you look at the goods sector, there's been very intense supply bottlenecks there. However, there are some more structural factors that we can see being more entrenched in the economy. If you look at the service side, we expect a handoff from goods to services as it relates to inflationary pressures. Wage pressures are going to continue to mount here. If you look at the labor force, the size of the labor force has decreased. So what that means is that workers are changing the way they look at employment, changing the way they look at work. So to bring them back into the market, you have to now entice them with higher wages. So we do think that that is a risk to de-anchor inflation expectations here. One of the key risks that we see going forward is that the Fed is behind the curve and is going to have to hike rates at a faster pace than the market expects going forward. We think that this can lead to a lot of volatility in the market, push spreads wider, and it's one of the reasons why we are still modestly defensive as it relates to investment-grade credit and corporate credit in general.
Gabriella, what about stocks, equities, investors? It's at the end of the year. I mean, inflation gives some companies pricing power. For people that I don't know why you defend inflation, but there are people that say a little bit of it is okay. Is it ever okay?
So I think the point we would make is that this is going to be a cycle at the end of the day that is characterized with a little bit more inflation than the last one. So we upgraded our inflation expectations for the next 10 years from 2% to 2.3%. And the conclusion for us is let's invest then in this inflation. So that means overweighting stocks versus bonds. It means overweighting certain more cyclical areas of the market that actually benefit from higher inflation prices, that are able to pass those costs on to consumers, things like materials, things like industrials, certain parts of consumer discretionary, or other parts of the market that benefit from what we believe will ultimately be a steeper curve, like financials. Another aspect of this is also to overweight international stocks because they have a lot more of those sectors that we mentioned. And then lastly, really the big winners over the next cycle in higher inflation environment ultimately is real assets. Things like real estate, infrastructure, absolutely essential.
Shepard Smith here. Thanks for watching CNBC on YouTube.